Good afternoon, John Simcock, and good afternoon to Paul Slinger. Welcome. As other people join, I'll take you through today.
Good afternoon, everyone.
Yeah, good afternoon from Rebecca. For those of you who are normal attendees, we're going to be using Slido today. If you want to get Slido ready, you certainly can, and we'll load the poll up. You can get into Slido two ways. You can go to QR Reader, use it on your phone, or if you don't want to use your phone, but you want to split your screen, you can go to slido.com. Today's code is LM170921, which is today's date, which makes it simple. If you want to let people know who you are and in the room, please feel free to use the chat. And that gives an idea of maybe someone who knows you or whatever, or certainly where you're from. These webinars come from, as you can see on the screen, all over from the Southwest up to Yorkshire, Humber, the London, down into Wales, the Midlands. So you can say where you're from. That helps us to understand. In terms of questions today, questions for Rebecca, you'll be able to use Slido for that. If you go to the Q&A on Slido, please put your questions in. If you'd like to own your questions, you can select to put it under your name rather than remain anonymous. If you think a question's particularly pertinent, one you'd like, you can vote for it, which will bring it up to the top of the menu for being answered. And we will also, at the end of today's session, be running a little feedback poll, which we normally do, which we'd appreciate if you take a few minutes. Well, it doesn't take very long, a couple of minutes, just to give us feedback. We will leave that open at the end so that it goes past the witching hour of 1 o'clock. So if you've got a couple of minutes at the end, we'd really appreciate that. So I think what we'll do, we'll start by having a look at today's poll. So Abraham, I don't know if you'd like to bring up today's poll questions. We're going to be looking at the poll in two parts today. So the first question we have, as you'll see, let's put the question up. It very much will help Rebecca to perhaps focus on things in her talk. So what we'll do is we'll all take the poll if we can, and that will help Rebecca. And we will run through that in a few minutes. But the other questions after this, if you want to continue answering those, you can. We'll run through those after the session. Now, as you can choose which you want of these. I think all of them are really interesting. Rebecca and I have just been having a talk about trade credit. And so if you'd like to fill that poll in, that question in, that's fine. What we'll do is we'll go to the next question. So Abraham, if you could put the next question. Do you take out credit insurance? Yes, simple answer. No, I don't perceive it as a risk. No one has spoken to me about it before. No, I have other protections in place. No, but I have had in the past. No, it's too expensive. So please make your choice. And as far as I'm going to say, interesting. Okay, I've made my choice. Next question. Do you ever lose out on new contracts because you're not able to offer the levels of credit? Okay, the next question, please. Which of the following have impacted your business the most since the start of COVID-19? Is it just one choice on this, or can we do more than one on this, Abraham?
Just one choice. Do you want
just
one?
Choice? Yeah, okay.
I suppose it's which one, Howard, has had the biggest
Yes,
impact.
the biggest. Yeah.
I can imagine for most businesses that a lot of them will have had an impact, but I suppose it's just a matter of, which one has had the biggest impact.
Yes. Yeah. Okay. And the next question then, please, Abraham. How do you assess new customers' creditworthiness? Applying for a credit limit via credit insurance policy,
I'll go into
status agent reports such as Experian, via past trading history, word of mouth. So which one of those do you use?
So you've done the design.
And the next question, please. Whether you buy credit insurance or not, which of these credit insurance benefits are most important to you? Is this a multiple choice or is this just one?
I believe it's just one, Howard. Which one is the most important to the business?
Right. Five people have answered, so
Right.
That's great.
Yeah.
But that will have answered all of them. Let's just give them another minute, because then we can go back to the first question, which is the one we're going to give answers. See the answers now. Only 5 people have participated, so please do feel free. That's a very small percentage of people in the room, so let's just give it a little bit more time. Be nice if we could get 50% of the people in the room to do it. So no pressure, please. Showing my competitive edge here. Okay, let's go to the answer to the first one. Someone may have answered that one by the time we get there. So what are you most interested in understanding whilst attending this session? Okay, so let's see. Pretty clear, I think.
Getting a credit insurance market update. Yeah, that's great. And I'm going to cover that today. So I'm going to go through what's been happening in the credit insurance world and in particular the construction market. So fantastic. That's what I wanted to hear.
Is that what you would be expecting?
Yeah, I would expect that. I think the nature of, being in the pandemic, the impact it's had, the market is one of the key things that I get asked the most by customers. Can you give me an update on how the credit insurance market is performing? So yeah, that is what I'd expect. So that's fantastic.
I think the second one would be quite interesting. What a construction policy covers, because I'm sure have changes taken place over the last sort of 18 months in these on policies?
So I wouldn't say that construction policies have been the wording has been changed on the back of COVID. But what I would say is certain endorsements in the construction policies have been used more during the pandemic, if that makes sense.
Is that by the insurer trying to sort of slide out of what they think is their liability, no doubt?
Well, just what they cover and making sure that it fits what the customers require. But I'll be pleased to say, no, it's not. We haven't seen the case where they've been trying to get out of paying claims, which is good.
Okay, right. Well, thanks very much to everyone. We'll come back to the rest of the poll after Rebecca's presentation. So I'm now going to hand over to Rebecca and look forward to getting an update from you, Rebecca. Many thanks.
Right. Okay, thank you. So I'm just going to sharing my screen. Okay, can you see that okay, Howard?
Yeah, I can indeed. Thanks very much.
Okay, perfect. Yeah, so thank you everyone for having me here today. I'm Rebecca Liddell from the Marsh Trade Credit team, and I work with companies around the UK to support them with their credit insurance requirements. So today, I'm going to talk a bit about our team at Marsh, talk about the benefits of credit insurance and the different type of policies that are available to businesses. And then, most importantly, give a market update, because that's what most people are interested in listening to, and talking about the impact on the construction market. I'm going to give a bit of insight into specific construction endorsements that fit your sector, and then talk about the forecast environment going forward with potentially insolvencies on the increase. And then there'll be time at the end for any questions and answers that you may have. So first of all, who am I? So I'm a development manager in the trade credit team. I've worked at Marsh now for 4 years. And prior to that, I worked in the financial services industry. Our trade credit team, we've got 133 staff UK-wide here to support our clients. And we speak to all UK underwriters to help our customers place policies and look after their credit insurance. So what is credit insurance? A credit insurance policy protects a business from bad debt. I always think it's useful to look at a specific example within your sector. So we have a big builder's merchant that we look after a credit insurance policy for. They've got a credit insurance policy in place with credit limits on all their key customers. In the event that one of their customers doesn't pay an invoice, they can make a claim on the policy for that bad debt. This customer in particular had a credit insurance policy in place when, unfortunately, Carillion went pop. So they were able to make a claim on the policy for the Carillion insolvency, and therefore it protected the business's balance sheet on the back of that bad debt. Another benefit of a policy is for sort of funding reasons. We have a lot of customers that have invoice finance, and the funder will require a credit insurance policy to be in place to protect that money. A lot of our customers will have the bank listed as a loss payee, which means in the event of a bad debt with the policy, the claim gets paid out to the funder. Businesses that have credit insurance policies, they can extend credit terms. So let's just say you've got a customer, you're happy to give them 30 days credit terms, but the insurer is happy to insure you for 60 days, 90 days. You can extend those credit terms with that company, and in turn, you might have more of a competitive edge over your competition. Also, you might be comfortable giving Fred Bloggs Limited $1 million credit limit. That's all you feel comfortable with as a business, that exposure. But the insurer might be happy to offer 2 million cover, and therefore you can provide more credit, larger credit limits to your customers, and essentially the insurer's taking that risk on your behalf. And finally, we find that businesses that take out credit insurance, their business tends to grow. If you can offer your customers credit terms that are insured, then in turn, if you have a bad debt, that won't impact your business, won't impact your turnover, and you're working with the right sort of customers providing credit to. The different types of credit insurance policies that are available, these are the 3 key types. What I would say is whole turnover is the most common, and that is what it says on the tin. You get a policy in place that covers your whole book of customers. In the event of a bad debt, all your credit limits, all the ones that are covered, are listed there, and you can make a claim on the policy for one of those bad debts. There's also key buyer cover. So if you had, for example, 5 top customers that you wanted to insure against, so let's say you were a food company trading with supermarkets and you just wanted to insure Asda, Tesco, Sainsbury, Morrisons, you can get multi-buyer policies. And finally, single buyer, you can get insurance on just one risk. So if you have one customer that you're worried about, you can get a policy. What I would say is that these kind of customers need to be listed very strongly, like investment grade, to qualify. And also single risk, it can be quite an expensive type of insurance. So most customers tend to go for whole turnover policies. So moving on to the most important part, giving the market update. So what we found when the COVID pandemic hit, credit insurers were very nervous and were set to reduce capacity because they thought insolvencies were coming thick and fast. The insurers and brokers like us lobbied the government to provide some kind of support, and they provided a £10 billion reinsurance scheme, which ran till the end of June 2021. And what this scheme did was all the credit insurers, or nearly all the credit insurers, should I say, gave their premiums to the government, and in return, the government would pay out any claims that happened. Also, the government introduced a prevention of winding up orders, so companies couldn't become insolvent during the pandemic on the back of COVID. Therefore, what actually happened was there were very few insolvencies in the market, and in turn, the government didn't have to pay out claims, and the government got to keep that premium. So the government did very well out of that scheme. What it meant for our policyholders is in the majority of cases, credit limits were kept in place, which meant the economy were able to trade on credit terms. So it's been really, really positive. There was also the furlough schemes, grants being offered. So there's been a lot of support for businesses. What the insurers are now worried about is now all that support's ended and businesses have got to pay back these loans, etc. They're worried that there's going to be a spike of insolvencies. But at the moment, as things stand, premiums have not increased on the back of COVID because there hasn't been the claims. So as things stand at the moment, the credit insurance market is doing very well, and it's not like some of the general insurance sectors where we have seen premiums increase. Now, specifically talking about the impact on the construction sector. So what we found was the construction sector did very well during COVID, especially compared to other sectors. There was a lot of collaboration that went on. Main contractors who tend to be the top of the chain and in sort of control of the payment schedules for projects, they offered early payment schemes to a lot of the subcontractors, which meant that as it went down the chain, the money was flowing quite quickly, and the businesses' projects tended to work really well. We also found that construction companies were not really taking on new tenders during the pandemic, but they were really keen to fulfill orders and make sure that they were delivered from start to finish. What we've noticed now is the cash focus, where the main contractors were paying cash potentially quicker than usual. That's been lost a bit, but it certainly was there at the beginning of the pandemic at the peak. With regards to the specific outlook and the impact within the individual sort of sectors within the construction sector, we found that the house building sector did really, really well throughout, but commercial office space is where there has been an impact. We all know about the rise in people wanting to work from home, and therefore this sector has had more of a challenge, where less people are returning to work and commercial office space is being needed less. The credit insurers have noticed some construction insolvencies starting to come in on the back of the government support being reduced. So that started already, but as I say, it's not really had an impact on premium yet. We've heard about some bidding wars and prices being driven down. There's always tight margins within construction, so these bidding wars can make jobs potentially unprofitable at times. The biggest impacts that I noticed from talking to my construction clients is the increase in prices on raw materials. Everything from the cost of boilers, the cost of timber, the cost of everything across you can think of. My clients are saying that the increase in raw materials is really hitting them hard, and the cost of transporting them. So I've got a customer that sells bathroom equipment, taps, all of that sort of thing. And they said a container prior to COVID cost them £200, and now shipping it over from China is costing them £1,400. So you can see how that is having a massive knock-on effect. This increase in cost in the delivery of these goods is really increasing the the price, and in turn a knock-on effect with the end customer. Also, another big knock-on effect is the lack of skilled labour in the construction market. Brexit has not helped with that. There's just not enough construction workers to fulfil the jobs that are needed, and therefore there's a big queue of work that's building up with not enough people to deliver those jobs, unfortunately. So, talking specifically about construction insurance policies, construction risk is very different to the risk of other sectors. So typically a credit insurance policy for a company selling, let's say a business selling bananas to Tesco's, they will get a credit limit on Tesco. In the event that Tesco goes bust, they've sent an invoice to Tesco on 60 days and the credit insurance policy would pay out that invoice. Within construction, you've got a lot of subcontractors that are doing applications for payment. So credit insurers have specific construction policies which are tailored to work for the construction sector. A lot of these underwriters are very close to companies. They might be providing bonds and surety for them, therefore are very likely to have the latest financials and are more confident, or in some cases less confident, to write cover on those businesses. One of the insurers, Tokio Marine HCC, who have a lot of construction policies, they were originally set up by QSs, and I know in the event that if there's a company goes bust and a application for payment hasn't been certified, they've got their own QSs that they can send out to value the work. So, just to give you confidence that if you're a construction company and you're looking for a construction policy, the credit insurers do get your business and can cater for that. As I've said here, they can cover for retentions, final account balances, work done off site, which I'll cover on the next slide. So the key things that sort of stand out for me that make construction policies different, binding contracts is a key one. So let's say, for example, we'll use, I'm not sure of the exact audience on here today, so I won't pick on construction companies that could potentially be on this in this meeting. But if we use the Carillion example, so let's say Carillion had a contract with Tesco's to build a new site for them. It was a 6-month contract, and it was a legally binding contract, so they must fulfil that order for Tesco. In the event Tesco had gone bust, a binding contract cover within a credit insurance policy would protect you for that binding contract, which means that the insurer is on the hook for that Tesco credit limit. And in the event that they want to remove that credit limit, they can't do so because they've offered binding contract cover. So it just gives you certainty if you've got legally binding contracts with your customer. Supply only cover, this would be for businesses. You might do applications for payment, but you might do supply only. So for example, you order a ton of gravel and it's delivered to the site and it's a straightforward invoice on 60 days, then that can be catered for. Credit insurance policies will often have group credit limits. So one that springs to mind, a business that has quite a few subsidiaries, Balfour Beatty. So you could get a limit on the top co. In the event that you're trading with 5 different subsidiaries, you don't need to apply for individual credit limits. You can have one group limit in place, and it just makes your life a bit easier that you don't need to keep adding limits if you're working with different subsidiaries. And finally, off-site costs. So this is also known in credit insurance as work in progress. And this is essentially bespoke work you do off-site. So let's say that you were a manufacturer of, say you're a carpentry company and you were making a staircase for Tesco's, then that staircase is bespoke to that job. It's an off-site cost. In the event that Tesco went bust and didn't pay you for that staircase, you could claim on the policy as an off-site offsite costs, bespoke work that's been done, but you haven't invoiced yet. Okay, you'll be pleased to know this is my final slide, because I don't want death by PowerPoint. But just finally talking about the outlook going forward. So insolvencies, as I said, have been very low during the pandemic. And as we're coming out of all the government support, we've started to see things slightly worsen. You can see here by this graph that I've got on the screen that the equivalent period in 2021, insolvencies have risen by 31%. So what we're saying to our customers that don't have credit insurance in place now is just, there is a forecast of an increase in bad debts. Now is a good time to look at credit insurance because the credit insurers have not put premiums up and still have a good risk appetite. So, you know, we'd recommend engaging with your broker. If you want to speak to Marsh, or if you have another broker, absolutely fine, then to review your concerns about credit insurance, to discuss going forward and get that protection in place. Okay, and that is it for me on my presentation. Shall I pass back over to you, Howard?
Yeah, please do. Please do. Thank you very much, Rebecca. For those of you who've got any questions, please do put them into the Q&A. I've certainly got 2 or 3, but before we get to that, what we'll do is we'll complete the answers for the poll, if we could.
That would be great.
Yeah, okay.
Yeah, that'd be great.
So I don't know whether we've had any change on the first question for those people who didn't manage to get their fingers on the button quickly. So let's see if that's changed at all. No, it hasn't. No, it hasn't. So that's fine. So let's move on to the next one. Do you take out credit insurance? Interestingly, no one has spoken to me about it before. So,
yeah, that's very interesting, Howard. That's really interesting that some of the businesses have never discussed it before. Yeah.
No, I find that interesting as well.
Yeah.
No, but I've had it in the past. So 29% of people said, yeah, I've had it in the past, but they don't take it out now. Interestingly, 14% don't perceive giving credit as a risk. I find that interesting. Yeah. And as to what other protections are in place, I'd be interested to hear. Would it be possible that people might be factoring their debt and therefore have it included in their agreement? Yeah,
I was just going to say that's what I would consider being the key reason, the key protection they might have is that they've got like a bad debt protection facility built in with the funder. Very interesting that no one in the presentation has a credit insurance policy. That's really, really interesting. And 29% have had it in the past. And you do find that businesses will have it and then maybe make a business decision to not have it anymore because they don't deem they don't see their credit risk as being in need of a policy. And all I'd say to that is that because of the nature of the risk horizon getting worse, it could be a good time to look at it again for your business.
Yeah, I mean, I'm not here to sell or talk about anything particularly, but I mean, if one looks at factoring, factoring would give you what, sort of up to 80% of funded debt, wouldn't it? And you probably would get cover. How much cover you get would be interesting, but what sort of cost do you reckon that would be? And what sort of cost is just getting insurance? Because you talked about covering all of your debts, covering some of them, or just specific ones. So if one looks at a factor, they're going to take a percentage of your turnover, aren't you? So it could be up to 2.5%, the cost of that, and then the cost of the money. What's the sort of cost for trade insurance at the moment?
Yeah, so what I'd say with funding, so companies might use, let's just use Bibby as an example. So if you use Bibby have got an arrangement in place with Euler Hermes. So built into the cost of the invoice finance is an arrangement with EULA to protect the bank's money. What we sometimes have is that EULA, as an example, might not be writing good enough cover on some of their key limits. So I had a customer that their biggest customer was not being written by one of the insurers with their funder. And so we found them an alternative credit insurer that the bank was happy to be put in place. And then the bank was listed as the loss payee, the entity that receives the claim payment. So it might be that the funder offers bad debt protection, but if you're not getting the cover you need, you can get a standalone credit insurance policy that's portable. So let's say you change funders in 6 months' time, you take that credit insurance policy with you, and you can list a different loss payee on it at a later date. So a credit insurance policy is portable, which is a big advantage. Price-wise, to be totally honest with you, I would say that my customers that have bad debt protection or that buy a standalone policy, the cost tends to be pretty sort of comparable. Customers, to get out of their bad debt protection policy, the funder has to reduce their rate by a certain amount. And often the funders are not overly generous about reducing their rate to then, take into account the credit insurance policy. So I'd say it's cost neutral, really, whether you have a credit insurance policy or a bad debt protection from that funder. But I'd say the biggest advantage is you could potentially get better credit limit appetite elsewhere, and the benefit of having a broker representing you if it's placed by a broker.
Rob Ford, who has joined us, and he says, I was late into the webinar. He says, I have credit insurance in place, in brackets, ensures I sleep well at night. And I think that's what a lot of people want out of insurance. But so how, if you go just for trade indemnity type of insurance, how's that costed? A percentage of the turnover you do, a flat fee, a 6 months at? How's it actually costed out?
Yeah, so for larger businesses, then you always tend to get rated policies. So let's say a business had 100 million turnover, for argument's sake, and let's say the premium rate was 0.1, then the premium would be £100,000 for that entity. So it's simply the premium rate multiplied by the turnover. Now, what you tend to find for large companies, they'll tend to have a larger excess in there. They'll have catastrophe type cover often, and therefore that risk share brings the premium rate down accordingly. So with regards to what does it typically cost, it's difficult to say. It does really vary as to the sector the customer's in and the bad debts they've had in the past, because an insurer will always have a look at what bad debts you've had, and if you've had a lot, then they'll think it could repeat themselves and the policy would need to pay out. Construction is one of the more higher risk sectors, and we do see more claims on policies in this sector. So you would see a higher premium rate with construction than, say, the pharmaceutical sector, which generally demands lower rates because it's less risk.
But splitting the risk is one way. How long does an insurer say they will keep a limit, given that certain large names may well be being sought as credit by many different companies?
Yeah, that's a very good question, Howard. So there are non-cancelable limits for some of the insurers. So AIG, for example, a lot of the policies they write, the credit limits are non-cancelable. So on day one, you get a limit on Tesco. That will be there for the 12-month policy period. But for an insurer to offer non-cancelable limits, it needs to be stronger graded buyers. And with construction, you tend to find that you see less non-cancelable cover. So typically, when an insurer writes a limit, they're writing that limit with the presumption that that is going to be in place for the whole 12 months policy period. But if the latest financials are released on one of your insured customers on your policy, and they're shocking, absolutely shocking, and the insurer thinks they're going to go bust, then there's a chance the insurer will either reduce that credit limit you have or remove the limit altogether. So credit limits can be removed policy. But the key thing to remember is all trade you've done with that customer up until the point the limit's removed is insured. So if today, and you normally get a 30-day notice period with most insurers, so let's say today a limit's removed, you've got 30 days to continue trading with that business. After that 30 days, any goods or services you've delivered up until the end of that limit being removed are still covered. So they're never going to pull out of paying a claim for something that's happened already, but it just means after the date the limit's removed, they won't write any, they won't be on the hook for any new business you take on with that customer. Does that make sense?
Just to me.
Yeah.
But if anyone else has any questions, please speak up, raise hands or whatever, and we'll come back to it. So let's move on to the next question, please, Abraham. Now, do you ever lose out on new contracts because you're unable to offer the levels of credit terms required? No said 57%, but 43% said yes.
Yeah, and this just shows you that if you do have that problem, then if you had a credit insurance policy and the insurer is willing to offer insure the extended credit terms, and that can help you win contracts like that might request these extended credit terms. It's just useful knowing that is an option to protect you. But it's good to know that 57%, the majority have not had an issue, which is great.
A lot of credit these days in not necessarily, I'm not saying the trade market, but a lot of credit is given automatically by computers. In other words, we get this data in, as long as it confirms what our algorithm says. What happens if you have a customer that's important to you? Can you work with the trade insurer to get information about your customer to them to see whether they'll underwrite credit? Or is it, sorry, you can't do that?
So what I'll just make sure I've understood your question properly. So as an example, if you've got a policy in place and today you want to start trading with a new business, you don't know whether you're confident offering credit terms, you don't know anything about them. We can check that business out for you with the credit insurer. So we can ask them sort of off the record and say, look, what do you know about Fred Bloggs Limited? And they will say, we're running lots of cover on them. We've not had any payment problems reported. We've not paid out claims on them. They're great. We're happy to write $1 million cover. We've seen 60 days payment terms, 90 days payment terms. Yeah, more than happy with them. So if you've got businesses that you want to offer credit limits on that you start working with, then we can speak to the credit insurer and find out information on them prior to you agreeing to work with that end customer. Does that answer your question, Howard?
Yes, I mean, I was thinking of, I'm a construction company. I'm going to build this. I want to bring in a firm of ground workers to put my basic sewers and everything else in place. They're relatively new. They're not known to the trade insurer. In what way might the trade insurer be able to be satisfied? Can I help to work with the trade insurer to get my customer covered? You know, what if is that possible?
Yeah, so if it's a customer you've not worked with before, but the insurer knows them, then it's standard, you know, applying for a credit limit. If it's a newly traded, a company that's just started trading, or you haven't got any experience with them, it's one way you would build up your experience. So what a lot of the insurers will say is they'll have a look at your they'll gradually build up that limit with that customer, as the customer pays you each month on time, you can increase that limit and the insurer will increase their exposure on that customer. Right. So it tends to build up over time on credit limits. With us as a broker, we will speak to insurers and ask them, this customer wants to get credit on this end buyer. What can we do to assist them? And they might say, can you give us financial forecasts for that company? Or if they've been trading for a year, can you give me their accounts? We will try and help our customers get credit limits for their end customers. So we're as a broker, we're here to help our customers get credit limits in place on their customers, because that's what the policy is there for.
Okay, Thanks. I mean, I only asked the question because in the construction sector, it's particularly as you go down the supply chain, new organizations come along, they spring up, unfortunately they disappear. And I think Martha Ortigan has a question here. Is there any way how providers can be covered against no payment by the contractor? I think what she's saying is there any way how providers can be covered against no payment by the contractor is by getting trade credit? I think that's really what she's asking.
Yeah, I think that's what she means. So by having a credit insurance policy in place, in the event that your customer doesn't pay, then the insurer will pay out that invoice on behalf of the company. Credit insurance policies are typically 90% indemnity, so the insurer would pay out 90% of the value of the bad debt, and the business would recoup those funds. But Mark, if that didn't answer your question, please please let us know.
Let's see. Let's open up, if we can, the microphone for Martha Abraham and see if we've answered her question, or whether she wants to put it another way or has a follow-on.
Hello, Martha.
Hi, thank you very much. I'm thinking, for instance, to cover 100% the contractor. I mean, what if I am building a huge building, for instance, and I am not satisfied with any of the works that have been done. So
right.
I want to cover 100% the money of the owner of the building. I don't know if I am explaining well, but if I am not satisfied with the work, I just simply don't pay. So
I get what,
how the providers are covered can work with me if that is one of my rules to contract to hire them.
Yeah, no, I understand what you're saying, Martha. So imagine that you work for Tesco's, you've asked Carillion to build a new store for you. Carillion have built it and you're very disappointed with the workmanship. It's falling apart and you've said, I'm not paying for that.
That is correct.
Yeah. And that happens a lot in construction where there's disputes, because workmanship problems, occur a lot. Obviously, there's retentions which are covered under a policy, but that's a separate issue. What I'd say to that, Martha, is the credit insurer will pay out in the event that it's gone to court and they've been told that party must pay. So credit insurance policies don't cover disputes. So what might happen is, I've ordered 1,000 widgets, I only received 500 widgets. I'm not paying for it because you've not delivered what I asked for. A credit insurance policy can't pay out for the wrong quantity of stock, and that's a dispute. Same with construction. If you're not happy with the workmanship, the credit insurance policy will not pay out because you're not happy with the workmanship. But what happens is it would go to court, and then when it's settled that Tesco must pay Carillion, or they must pay 40% of it, for example, then the credit insurer would then pay out a claim for the amount that the court has said is legally theirs. Does that answer your question, Martha?
Yes, I think it does, but I would like to find one cover for those who are going to work with me under this clause. If I say I don't pay, if I'm not satisfied, I will be disincentivating providers to work with me. And I would like to have something that covers them as well. I don't know if I am explaining well. It's to work in both ways. I am happy to pay if I am satisfied with the work.
Yeah.
But you are covered as well under that clause. I don't know if I am explaining well.
Yeah, I think you're saying
without
that
going to the court, because that would be an unfinished issue.
Yeah, you'd like to see protection in place for you as the company ordering the works, and the works are not to the quality you require. You would like to see protection for you as a business, but then you'd like to see protection in place for the contractor doing the work.
That is correct. Yeah.
Yeah, they might have done a good job. The business is being fussy and not wanting to pay, and you want to see protection both sides. Yeah. Well, credit insurance is, if you think of credit insurance more as covering businesses that have financial difficulties, that is really what it's there for. And disputes is not so much. I can send you further information, Martha, about
that would be great.
Yeah,
Thank you.
About how disputes are covered in credit insurance policies, because it is a massive topic. So I've made a note to send you further information on that, Martha.
And I will give you details, but about why I'm asking this question.
Yeah. Okay. Fantastic.
Yeah, I think you could understand better my
yeah. No, I understand, but we can speak again, and I can send you some further information.
Thank
Martha.
you. Thank you.
Okay.
Thank you very much.
Thanks, Martha. That's great. I wonder if we could move on to the next question in the poll, please, Abraham. Which of the following have impacted your business the most since the start of COVID-19? Interesting. 75% quite clear is the increasing cost of building materials.
Yeah.
Which one would suggest is likely to continue for quite a while to come, I would think.
Yeah, a lot of the businesses I speak to are saying that they don't see it going down anytime soon, and it's just had such a knock-on impact for businesses and you know, for consumers. I mean, my friend, she lives a few doors down from me. She got a quote for a loft conversion, and it was, what was it? It was something like £30,000. And it was just before COVID, and now the same contractor's quoting £60,000. So, you know, and that is because their building materials have gone up. They've got so much work on, and you know, prices have gone up so much.
Could be a bit of profiteering in that one, I think, but
yeah,
making the most.
Yeah.
Making the most of the opportunity. But I just wonder, I mean, you know, when one gives credit, you're sitting there as the credit provider, and you're thinking, all things being equal, you know, this is a 6-month contract. So in 6 months, my credit risk may well have expired on this. But now, when you've got not just increasing costs, but you've actually got supply chains where certain things cannot be delivered, that means the building work can't continue. You've then got skill shortages where you're not going to be able to get necessarily things done in the time frame you had.
Yeah.
Is this going to, do you think, come out in increased insurance costs because the insurer is going to have to carry the risk for longer, and maybe at a higher sum if they look at their spread over all of the people that they're underwriting?
Yeah, I'd say that the biggest knock-on effect to premiums is claims, Howard. I think as soon as insolvencies increase, I think that is where it's going to impact the credit insurance premiums the most, because if they're paying out more claims and they're less profitable, then in turn, you know, they're going to have to recoup the money, you know, somehow. But at the moment, we haven't seen any sort of real impact on premiums. Because
claims, because there hasn't yet been the insolvencies, but do you think they're going to be?
We think that there's going to be an increase in insolvencies, and we think that premiums will be impacted over the next, I would say, few months as the insolvencies increase. Yeah. So when customers are signing up for policies at the moment, we say to them, a bit like a mortgage, when you fixed your interest rate with your mortgage, you know, you'd say, you know, you've been given a competitive rate. We would recommend you lock this in for 2 years, get a 2-year deal, because you've got that certainty that if premiums do increase, you've got this lower rate locked in for 2 years. So yeah, I do think premiums will increase. How much, we don't know, and we don't know how bad the insolvencies will be, but this is what, you know, the insurers are forecasting.
Okay, I've got a couple of questions that come in. One's from Mike Cheney. Is credit insurance in the moment like PI, or does it cover retrospective claims when the policy was in place?
Yeah, that's a very good question. So credit insurance policies are typically risks attaching, which means when the policy goes live, so let's say you get a policy that goes live on the 1st of January, it covers you for any goods or services that are delivered from that date onwards. So if, for example, you had a policy 1st of Jan to the 31st of December and you don't renew that policy, and then an invoice that you sent out in August of that year doesn't get paid, and that company goes bust after that policy period, because that policy is risk attaching, you would be able to make a retrospective claim on that policy. So if you think of a credit insurance policy as covering you for goods and services delivered within that period, it doesn't matter when that company goes bust, as long as it covers an invoice within that sort of 12-month period. So yes, Mike, it does cover retrospective claims, as long as it was some work you did during the policy period.
Okay, Mike, hopefully answer that. If not, do come back to us. Abraham, we've got one more question that came up. If you work only for LA or HA, then there is no credit risk, in my opinion. If you work directly for these clients, is our experience. Otherwise, yes.
Okay, so yeah, so one thing the credit insurers are universal about is if you work with government departments, as they call it, they do not need a credit limit on them. So for example, you do work for the NHS. The credit insurers say the NHS is not going to go bust, therefore you don't need a credit limit on them. If you work for local authorities, housing associations, what I would say with those is it can be, it's a bit of a grey area, but I would say my gut feeling is the credit insurers would probably not credit insure those, not see them as a credit risk. And therefore, if you trade solely with local authorities, housing associations, I would say you probably wouldn't need a credit insurance policy. But I have a lot of customers that do private work and government work, and they just remove the turnover for the government stuff and insure the rest of it. So yeah, I'd agree that there is no credit risk typically for those. But as I say, it's a grey area because with NHS, for example, there's NHS trusts and the insurers will insure those because there's been cases where they have gone bust, but they won't insure the standalone NHS. So I can't say for definite about local authorities or housing associations, but I'm pretty confident the insurers would see that as government and not need to insure them.
Great, thanks very much, Rebecca. Can we go back to the poll? I think we've got, yeah. We've done that one.
Oh, how do you assess new customers and
experience seems to be a popular way here.
Yeah. So status agent reports. So you have Experian, Credit Safe, D&B, for example. A lot of businesses will check out their businesses that they're working with on those first before providing credit terms. They're all great. What I would say is just some of their information is a bit out of date. So it will pull information from Companies House, for example, and the financials can be out of date. So the credit insurers will have more current information because they've got lots of policyholders that are trading with those customers, so they'll have recent payment performance problems, etc. But the status agent reports are useful. And then, yeah, trading history. A lot of companies go by the past trading history with the customer and decide whether they're happy providing those levels of credit. And then, yeah, none via a credit insurance policy, and that's because no one that filled out the poll had a credit insurance policy.
But hopefully after this, they may be.
Everyone will be flocking to buy one.
Whether you buy credit insurance or not, which of these credit insurance benefits are most important to you? I think the first one, replaces bad debt quickly. I think it's really a key one, really, I would have thought for people. Yeah,
no, and when people, when businesses buy a policy, the key reason is to protect against bad debts, especially sort of, torpedo losses, which can really impact the balance sheet. So protection tends to be the key thing. And as one of the delegates today said about being able to sleep well, think
Yeah,
that's a really key reason. It's peace of mind knowing that you can carry on trading with your customers, knowing that if one of them doesn't pay, the insurer will pay that invoice for you. So it does help you sleep at night knowing you've got that protection in place.
And I think that's the confidence down at the bottom. It allows you to make informed decisions. In other words, you actually get contracts with people who are going to pay you. Yeah,
exactly. Yeah, you know that they're going to pay you, and if they don't, then the insurer will.
Yeah. And also, I think funding is an interesting one. Improves access to finance. People don't realise that actually good credit insurance can actually improve your funding and cash flow.
Totally.
It costs, but in today's market, money's not that expensive, so it's a good way of looking at it.
No, totally.
Okay.
Yeah. No. If a business has a credit insurance policy and they decide they want to take out invoice finance, for example, and the bank knows that their money the invoices they're funding against are protected, then that could potentially, they could generate a better, more competitive rate for you because you've got a policy in place.
Well, you might be able to get up to 80% of the money that you're actually out on credit and invoices.
Value of invoices, yeah.
It's quite a lot of cash flow.
Yeah.
Okay, thanks for that. Let's take that down. We're going to put up now, not going to put it up on the screen, but the feedback survey is now open for people. So please do take the opportunity to give us your feedback on today. If you would like to get a continuing professional development certificate from today, you can do that by going to CE773, by going to My Pro Pass account, entering that, and they will send you along a certificate for that. And next Friday, we have another webinar, this time embedding sustainability into procurement. So every construction and infrastructure project can be part of our emergency response to climate change. So if you're interested in looking at that, please do register and come along next week. Finally, I'd just like to thank you for participating today. And I'm particular for Rebecca for all her knowledge and experience. Thank you very much.
It's an absolute pleasure.
And I'm sure if anyone's got any questions or they'd like any information from you or whatever, to contact you. So
I'd be really happy to help. And thank you everyone for your questions. It was really good engaging with you all.
So all I'm going to say is have a great weekend and we'll see you next Friday. Many thanks. Bye.
Thank you. Bye.